Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on the market's bounce back from Brexit panic. Author of several books on the economy, including The Money Bubble, John Rubino, says stocks, bonds, real estate, and gold all going up at the same time is not a healthy sign. We'll talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
We're chatting with Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Ross, how has the flight to safety gone after the Brexit vote?
Well, as we know, the first few days post-Brexit, everyone was running for the hills, but since then we've seen one of the strongest markets, at least the equity markets, in years. And it's so typical that the items that people fear the most are the ones that are least likely to have the negative impact. So in particular, the bond market, the gold market, which had really been the flight to safety items following Brexit, they continued up until a week ago Friday. Now, at that point, we put out a special report on the bonds because the excesses that we were seeing were very, very important. When we look at the weekly chart, we could see that the channel that bonds have been rising in since interest rates peaked out back in 1980, 82, when we were up in double-digit rates. The bond market's been in a nice rising channel, and there have been a dozen times that it's been to the top end of that channel and given some very, very good overbought readings. We classify those as exhaustion points because they have some very set criteria that we look at the reversal points, and that's what we saw as of the week ending the 8th, and this week clearly we saw the downside reversal there, and with it gold market giving up quite a bit of ground down into the 1320s, and once the bonds have had a rally to that extent and start to back off, that's when you see some really good action in the equity market, and also in any of the higher risk items in the bond area, like JNK and HYG, which are the high yield bond ETFs. Those have come to life with equities, and we would expect to see this last for at least a few more weeks. The election cycle that we look at in equities has had just a really good run in the right timing window, which was to carry us into mid-July through the first part of August. So so far so good from that perspective.
What about the oil market? We did reach a peak of just over $50. Are we going to continue to stay in the 45 to 50 range?
I'm hoping that we do. The correction was down to about the right level. We got down to $44 in round numbers. Been looking for the 100-day moving average to provide support, and it kissed right into that in the last week. The other thing that we take a look at is from in the bear markets in the oil. You take a look at that first 150 days up, and I've got a very nice chart that I can send along to people. Take a look at how long the rallies extend, and then this type of correction for the period of the corrective process there before you start to see your life come back to the market. And we pretty much now completed the necessary time of this correction coming down from the $52 level. So you'd expect to see some reasonable buoyancy in here. May or may not take out that $52 high, but I think the worst of the break is presently behind us, and therefore you'd expect to see the oil complex, the stocks themselves, which have actually been outperforming the crude oil. They should continue to do reasonably well here in the next month or so.
Gold and silver, again, a nice rise to start off the year. Is that going to continue, or will we have a bit of a break?
Well, what you would expect to see, first of all, from a seasonal perspective, last week, the July 17th or 12th to 17th is the window that you look for gold market to come to life. It had already started its secondary push here through 1300 well before that. So if anything, it was ahead of itself and in need of a correction. The thing that's missing that was in terms of saying, is this the end of the run, is that the mining stocks, you take a look at the silver stocks, the golds, the GDXJ indices, they continue to do extremely well. So there's no bearish divergence in here in stocks relative to bullion. So as long as corrections in the miners hold reasonably well, if they can hold about half of the gains that we had off that May-June low, I think things are pretty healthy still for that complex.
The central banks in Europe and Japan have gone to negative interest rates. How's that working out for them?
Well, it's clearly, trying to create an inflationary push by making it not worthwhile to save your money has done no good at all. And it's clearly that it's an issue that the central bankers and all of the theorists have gotten wrong. I don't think that there's a chance here that we're going to stay down into these negative interest rates too much longer before we see a bit of a pause back. I see the German rates, the 10 years, which had gone negative, are now just inching back above the zero line. But as long as I think you've got something like 30% of all sovereign debt around the world right now is at negative rates. If we're going to continue to see this for any length of time, even if they stay down, I don't think that the Canadian and U.S. ones are going to go down to match that. So you'll probably see a good underlying bias as far as the U.S. dollar is concerned.
Ross, thanks for being on This Week in Money.
And we will be with you next week, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross or would like to take a look at some of his charts, you can email Ross at ross.clark@cibc.ca. Coming up, John Rubino on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is John Rubino, author of several books on the economy, including The Money Bubble. His website, dollarcollapse.com. Welcome to This Week in Money, John.
Hey, Jim. How's it going?
It's going great. I'm wondering about currencies right now. The British pound, of course, being pounded. Is this actually going to work in their favor?
Yeah. The people who are really worried about the whole Brexit transition are not paying attention to the currency war angle here. Britain managed to devalue its currency really aggressively here. And so that's going to lead to cheaper exports being more in demand around the world and tourism suddenly ramping up because all of a sudden it's a lot cheaper to visit London, right? And so those two things will be net major positives for Britain going forward. And that'll offset a lot of the turmoil of having to, restructure their regulatory system when they pull out of the EU, among other things. So I don't think it's nearly as bad as the original reaction seemed to think it would be. And I think people are catching on now because British stocks are up dramatically lately. They tanked to begin with, and then they went back up, along with the equity markets of the rest of the world. People just stopped worrying about Brexit about 3 days after the election, which is a pretty good illustration of the whole, buy the rumor, sell the fact kind of investment strategy. You could have shorted everything in sight leading up to Brexit and then gotten out of your shorts over the following week at a pretty nice profit and then gone long and ridden everything back up. So that's basically what happened. And I think that all along Brexit was more important for what it represented than for what it actually is, because it represents the beginning of a trend that is going to gain steam within continental Europe. A lot of other countries are going to want Brexit-style referendums or legislation going forward, depending on their system. And that's going to cause political turmoil, really, as far as the eye can see, because, you got France and Italy especially, with very powerful political parties who are anti-Euro and anti-EU, and they're going to have their say in the next year, and very possibly engineer something similar to Brexit. And that's a much bigger deal than Britain, which is near Europe but not really necessarily a part of continental Europe, because they were never part of the Eurozone, for instance. They don't use the euro, they have their own currency. But let a country that is using the euro decide to pull out of that system, and things get a lot more choppy, and that's what Brexit, by making it clear that something like that is possible, has established for the rest of Europe going forward. So yeah, I think the crazy times have just begun, and they're about to get a lot crazier.
Do you have any read on the new British Prime Minister, Theresa May? She made a statement saying Britain is for everyone, it's not just for the elite, which seems kind of leftist for a conservative prime minister.
Well, Britain has to sort its personality out now, basically, because all three of the major parties lost their leaders, and so they're all in the process of recreating themselves in a post-Brexit world. So it's really not clear how this shakes out. But there are some things that are pretty clearly in the nature of stuff that has to be said. You've got to make certain noises, no matter what party you are going to lead going forward. And so you're going to see a lot of that, which is basically boilerplate. It's stuff that really doesn't necessarily mean anything, but it's the kind of noise that you've got to make while you're attaining office. And then you get to start putting your policies into place, and we see what you really think. So that's what's out there in the year ahead for Britain, where they establish the personalities of the major parties, or I should say reestablish the personalities, and then figure out who's going to be in charge, and then start putting policy together. So it's probably 2017 before they really get down to the business of extracting themselves from the European Union. And that's when things, from Britain's point of view, get very interesting, because if the EU makes it really hard for them, which I think the EU is leaning towards, because they want to make sure that it's not an easy, happy process leaving the system, because that will encourage other countries to do it. And the harder it is for Britain to get out, the less likely it is that France or Italy or some other Eurozone EU country will try the same thing. So, again, crazy times coming. There's no real way to predict how it all plays out, but it's going to be volatile, and the stuff that's being done now financially around the world doesn't work. And so that, more than anything, is what tells us that the next few years are going to be really tumultuous, because the governments of the world have tried some very serious monetary and fiscal experiments post 2000 tech stock bubble bursting, and it hasn't worked. Basically, all it's done is maintain the status quo at the cost of massive, massive increases of new debt. And that's coming back to bite us, and it's being countered with more of the same. So I'm sitting here right now putting together an article on how the major governments of the world have decided that they're going to respond to Brexit and the global slowdown and yada yada, all the problems that we have that in a lot of cases, flow from their failed experiments of the past few years with more of the same. Japan just reelected Shinzo Abe, who's the architect of Abenomics, which is massive government deficits financed with a record-breaking increase in the currency supply in Japan. And they basically have deflation going on right now, and their economy's not growing at all. So they put the same guy back in charge, and he orders his ministers to come up with a stimulus budget. In other words, they're going to try more of the same, and push interest rates down further into negative territory and increase government borrowing. And their rationale is that because interest rates are so low, and in many cases in Japan negative, that now's a great time for governments to borrow and invest, and which misses really the crucial point of the process, which is that if you take on huge amounts of new debt when interest rates are negative, that helps your budget in the short run, but that means you can also never renormalize interest rates. And since interest rates are a mechanism for moving savings into productive investment, and if you destroy that pricing mechanism so that the price of money no longer means anything and you can't tell where to or whether to save in the first place and then where to invest your savings, then capitalism crashes and burns. You destroy the basic mechanism of the system on which your system is based. And that's what we're going to get if governments ramp up their borrowing at negative interest rates, thinking they're getting a good deal. They're actually destroying the goose that lays the golden egg. If capitalist markets don't work, then we're back in the Middle Ages, because the only thing that separates us from the pre-industrial revolution, basic dark ages for 10,000 years, is capitalism. And the technologies that have flowed from capitalist investment, and you take that away, and it's game over. And that's what we're doing. That's the new policy of these supposedly smart governments. And anyhow, beyond Japan, you've got Mark Carney, who's the head of the Bank of England, talking about doing a preemptive interest rate cut here to head off whatever trouble might flow from the Brexit process. So he's going to aggressively stimulate the British economy with more monetary experiments. And then you've got the U.S., where in Australia overnight, a Fed governor just came out and said that the next step in U.S. monetary policy is helicopter money, which is this thing that was kind of mythical, that nobody ever thought would happen, where the government can engineer inflation by just dropping $20 bills out of helicopters. Well, we're working now on the modern version of that, which is massive increases in government spending, in which the government basically gives money to people, and then the central bank finances it by printing new money. So basically they're going to print a bunch of new dollars, or create them electronically, and give them to people, with the idea that somehow that leads to economic growth rather than this global massive monetary crisis, which is what's going to happen if we create infinite quantities of new currency and just hand it to people. So the year ahead, if as amazing as this sounds, is going to be even crazier than the previous few years, and it's going to set the stage for a crisis that's even bigger and really epic. So nothing that has ever happened in the past is going to be like what's coming. And that's what we're looking at now. The next few years are just going to be amazing. And we see the stage being set for it now in the announcements of the major governments.
We'll have more with John Rubino next on This Week in Money.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior. With a proven operator and finance team, Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
We're speaking with John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. John, with so much turmoil out in the world, obviously precious metals are looking better and better.
Yeah, the world that I just described is paradise for gold and silver, because that's where we hide out when we lose faith in the national fiat currencies that are run by national central banks and in the ability of governments to continue to borrow and spend to keep getting reelected. You know, when we lose faith in systems like that and decide that they don't any longer serve our interests, and we start worrying about a crisis that's going to flow from the fact that the government no longer works, we buy gold and silver. You know, this has been the case for 3,000 years. That's where we hide out. That's the thing that goes up in value in local currency terms when we destroy those local currencies. And we are actively trying to destroy those local currencies. So, not to say that there won't be a correction in the short run in gold and silver prices, because they've had this huge run, and by a lot of technical indicators, they're grossly overbought. So it's easy to imagine gold and silver going down by 10 or 15% each, maybe less in the case of gold and more in the case of silver, over the next few months. But that would just be a buying opportunity in this world, because government policy is all pointing towards the kind of environment that is just going to be phenomenal for precious metals prices and for other real assets. You know, it's going to be good for farmland and stuff like that too. But gold and silver is much easier for individuals to buy into. And so you see a lot of individual money flowing into gold and silver 1-ounce coins. At the same time, you're seeing a lot of Eastern government money, China, India, Russia, snarfing up all the gold they can get a hold of to boost their monetary reserves. So you put those two things together, and there will be demand for more gold than the world's gold mines produce in a given year, and that shortage will cause a spike in the price. And so, again, you know, we're kind of creating the conditions in which stuff like this is baked into the cake. You know, financial crisis, soaring gold and silver, blah blah blah. You know, all the crisis investing truisms that are only true for a couple of years out of every 6 or 7 usually, you know, and then it goes back to traditional stuff like stocks and bonds. Well, the crisis investing thing is coming back now. You know, we're guaranteeing that bad things are going to happen and that capital will be terrified and will flow into sure things like gold and silver. So here we go. Once again, it's 2008 all over again, it looks like.
Does silver give you more bang for the buck?
Oh my God, yeah. Silver is a tiny little market of just a few tens of billions of dollars based on what's available out there. And the reason for that is that gold, when it's found and mined, is saved. You know, so basically all the gold that has ever existed, that's ever been found, is still out there somewhere in jewelry or in central bank vaults or in tin cans buried in backyards. And so the supply of gold that's available in the market, theoretically, is much, much bigger than the supply of silver, because silver gets used industrially. Besides being a monetary metal, it's an industrial metal, and we don't recycle a lot of the silver that gets used. You know, in your phone has a little bit of silver in it. Your computer has a little bit of silver. The solar panels on your roof have some silver. And not all of that is put back into the market when those things are thrown away or replaced. And so the available supply of silver is much, much smaller in, you know, relative dollar terms than the available supply of gold. And because of that, when money starts flowing into gold and silver, frequently it flows in equal amounts. You know, we buy equal amounts of gold and silver out there, but in dollar terms, let's say, but there isn't an equal amount available. And so that will tend to push up the price of silver more aggressively than it will push up the price of gold. And, you know, you see that in every cycle as well. Silver goes down harder in bad times for precious metals, which is to say good times for the rest of the world, and goes up much more dramatically than gold does when things get crazy. And we've seen that lately here, where silver has outperformed gold, but the gold to silver price ratio is still at a really favorable level for silver. In other words, gold is much more expensive in relative terms than silver is. And so it's reasonable to expect that if the bull market in precious metals continues, that it'll benefit silver more than gold. Now, you obviously you take more of a risk when you buy silver because it's more volatile, but if you time it right, if you're there at the beginning of a long run where silver outperforms gold, even though gold is going up, you tend to really make a lot of money. And so we've seen that a couple of times with silver where it's gone from single digits to $50 twice in living memory. And so we didn't make it back down to single digits here in this bear market, but we got down into the 1350 range in U.S. dollars. And so if silver is going to go back up to 50, and a lot of people think it could go much, much higher than that because the numbers in terms of fiat currency that exists in the world and debt at government levels and private sector levels, all of these things are so much higher than they used to be that the amount of capital available to flow into silver is so much greater than it's ever been before. So we could see 100, 150 U.S. dollars per ounce of silver very, very easily in this move just based on the amount of paper money there is to flow into that market. And so, you go from 13 to 150, and you've had a really nice run. That's a life-changing investment decision to buy a bunch of silver at $13 an ounce. And the people that did it, there are very few people who did it, but, anybody who did is looking at a really, really nice 5 years out there. And even now, at $20 an ounce, if it goes to 100 or 150, you still made a really smart decision by buying some here.
Taking a look at other commodities that people might want to invest in, what about what I call consumables like coffee and sugar? Are they going to be big things?
Commodities are not a thing. Each one is different, and each one has different supply and demand characteristics. And so generally, the stuff that you can't make more of is the thing that does better than, say, an agricultural commodity where you can just plant more wheat, right, if the price goes up. And so that limits the upside volatility of something like an agricultural commodity. Whereas with farmland, for instance, that's all there is, and so it's hard to tear down condominiums and plant that land. That's not a very easy thing to do. So the amount of farmland in the world is more limited. And so its price tends to go up more dramatically. And in the past with energy assets, the same thing. There's more oil available year after year, but it goes up at a fairly predictable low single-digit rate. And so in the past, when there's been a monetary crisis of one sort or another, you've seen oil's price spike because of that, because you can't just go out and make 50% more oil this year than last, the way you can with an agricultural commodity. So in general, if you're looking at commodities and you're trying to separate the wheat from the chaff, so to speak, in an inflationary period, everything will go up, but the stuff that exists in limited and predictable supply will tend to go up more.
What is going to happen with oil? I've just heard today that the Middle Eastern nations that produce oil are putting out a record amount. Russia just cranked out a record amount of oil. Is this a commodity that's going to drop in price, or is it going to maintain somewhere between $40 and $50?
And that's a question for Rick Rule or some energy expert out there. I think in the long run, you've got to see solar power as a major threat for the world's fossil fuels. And it's crushing coal right now, because coal is a direct competitor, because that's where power plants get their electricity, if not from solar. And as solar gets cheaper, it's making coal less and less necessary in the global economy, and the coal companies are crashing. Oil is less of a direct competitor with new clean tech, clean energy technologies. So it isn't as immediately threatened. But I think in the long run, it is also threatened. So oil might have one more cycle, one more cyclical spike where it goes up into the hundreds. But at that point, I think it's really game over long term. So you could play oil now and assume that it's going to rise during the coming monetary crisis. But it's not a thing to put away for your grandkids. You know, you don't want to buy Exxon stock or, you know, God forbid, some little pipeline company or whatever, because you just don't know what's going to happen in that market, and it's threatened technologically for sure. So, okay, let me answer that more concisely to make sure I'm being clear. In the short run, I don't know. Oil could bounce around. In the long run, I'm very pessimistic about it.
The Dow Jones Industrial Average reached a record high. The NASDAQ near record highs as well. Can the equity markets be sustained?
Well, see, stocks and bonds going up the way they have is another artifact of the monetary bubble that's ongoing right now. You know, we're just creating huge amounts of new currency, and it's got to go somewhere. So some of it is flowing into equities, and some of it's flowing into bonds. So you've got record low interest rates, which is a sign of demand for bonds, and you've got record high stock prices, also a sign of extreme demand. Now, those two things don't normally happen together, right? Because plunging bond yields is a sign of a slowing economy, historically, which is bad for stocks because a slowing economy means lower corporate profits, which, you know, in the long run, corporate profits are what determines stock prices. And so usually you see one or the other. You know, a bond bull market coincides with an equities bear market and vice versa. But the fact that we're seeing bull markets everywhere means that governments are screwing up on a historically epic scale. They're printing too much currency, and that currency is bidding up the prices of pretty much everything. You know, when you see stocks, bonds, gold, and real estate all go up at the same time, you know you're blowing on a historically destructive bubble. And that's what we're doing right now. So when that bubble bursts, there's going to be turmoil in all of these different markets because money will be pulled back out or it'll just evaporate, you know, and that's going to cause problems for all kinds of investment strategies. Now the question is, does that happen this year, next year, or 10 years from now? And that's the one that's unanswerable because we don't know how far central banks can take their experiments before it blows up in their faces. Now I would say that there's a lot of signs that these experiments are already blowing up. And the fact that interest rates are negative all the way out to 10 years in Japan and Germany and 20 years in Switzerland and heading that way in the U.S. You know, when things like that happen, or when Italy can borrow for less than the U.S. has to pay, you know, those are crazy, crazy situations that people get used to when they see it that way for days or weeks or months or years, but they shouldn't get used to it because it's not a new normal that can be sustained. It's a new normal that is heading off a cliff, and that's basically our situation right now. We're creating the conditions for an absolutely epic financial crisis, and there are signs that, for instance, where China borrowed more money than any country has ever borrowed in human history, and then spend it, and yet their economy's not really growing because they misspent so much of it. Or Japan ran up their government debt and their central bank balance sheet to record levels in relation to the size of their economy, and their economy's not growing. So there are signs that this stuff doesn't work anymore, and all it does is increase your leverage without increasing any of the positive results of leverage. So I think there's a good chance that we resolve this sooner rather than later, and we resolve it in a really, really ugly way.
Wouldn't it have been better just to let the stock market collapse under its own weight instead of all these quantitative easing programs?
Oh, absolutely. You have to let markets clear. You know, if you borrow too much money, then you basically guarantee yourself a depression. You can't avoid it. Or you can delay it, but you can't avoid the eventual reckoning. And all we've done is put off the day that we have to deal with the debt we took on in the 1990s, really, and by taking on more debt, which means our reckoning is much bigger. You know, if we'd had our global financial downturn in 1990 and just flushed out a lot of that debt, we would have gotten rid of a lot of the tinder, a lot of the underbrush that's going to make the coming forest fires so hot and so destructive. But instead, we responded to the tech stock bubble bursting by creating huge amounts of new currency and cutting interest rates, and then we got the housing bubble. And when that burst, we responded to that in the same way by borrowing gargantuan amounts of money and creating just record, unbelievable amounts of new currency and dumping it out into the banking system. And we bought ourselves some more time that way. But now, with things slowing down, we've got literally quadruple the debt that we had when the tech stock bubble burst in 2000. I'm sorry, I said 1990 before. I meant to say 2000, which was the bursting of the tech stock bubble and the beginning of the current experimental monetary policy. So, if we had taken our medicine then, we would have had a rough few years, very rough. No doubt about that. But we would have gotten past it, and we could have gone forward with a more or less sustainable system. But instead, we created something that's vastly less sustainable than the world of 2000. And the price that we're going to have to pay for it is just really unprecedented. It's hard to see us getting out of this without something that is going to be written about in history books for the next 100 years.
You're listening to This Week in Money. My guest is John Rubino, and we'll have more with him coming up right after this break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with John Rubino, author of several books on the economy, including The Money Bubble. John, a little bit about maybe the social network that we're looking at. The International Monetary Fund has pointed out the gap between the low-income people in America and the very richest is growing by leaps and bounds. And I think they're hinting that some kind of social change has to happen to try to equalize things.
Well, yeah, inequality is exactly what you get when you increase the money supply and cut interest rates and ramp up government spending the way we've done it over the past few decades. Because in our system, when you create new currency, in order to finance government deficits, you give that money to the banks to begin with. That's how our monetary system works. So those big banks get all this new money to play with, and of course they lend it to their favored customers, who are the rich guys, the 1%. And those guys turn around and buy assets, because they've already got all the money that they need for eating, right? And they already have a roof over their head. So they buy trophy real estate, and they buy stocks and bonds and fine art, and that drives the price of those things up, making the rich even richer. So you get corporate CEOs making, 500 times what their lowest paid workers make, and you get guys with portfolios of fine art seeing their net worth quadruple in the space of a decade, or people with London penthouses, or whatever asset you want to name that regular people don't have access to, but rich people own all of. You end up with exactly the kind of society that we have now. It shouldn't be a surprise to anybody. And it also shouldn't be traced back and blamed on capitalism, because this is not capitalism. When governments grow excessively and then create a lot of new currency to finance their growth, you've got, I don't know what you want to call it. You could call it an aspect of socialism. You could call it crony capitalism, where the only people who get rich are the ones who are connected to the government in some way. Or you could call it socialism for the rich, or socialism for corporations. But it's not free market, theoretically pure capitalism, so it's a different problem. And it's also exactly what we should expect to get when we do that. So the only way to fix it is not with massive new government programs to funnel money into the hands of the have-nots. It's to scale back government subsidies for the rich. We need to let big banks fail when they get into trouble, instead of bailing them out so they can pay record bonuses to their workers with taxpayer money, as happened in 2008 and 2009. Just let them fail. You know, when a company makes a bad decision, its shareholders need to lose all their money, its executives need to be fired, and better, smarter competitors need to come in, buy out their assets, and then run that business correctly. That's how capitalism works. You need failure in order to guarantee long-term success. And so what we're trying to do now is to prevent failures from happening. And the analogy of a forest fire is perfect, because what the U.S. Department of the Interior did for the past 100 years was try to prevent forest fires. And in the process, we allowed all this dead wood to build up at the bottom of the forests, or on the floor of forests. And when fires do come now, they become uncontrollable because there's so much material to burn. And so what we've done with the economy is create the same kind of situation where we never want there to be a crisis. We never want our rich guys to suffer. And so we've created so much debt, which is analogous to underbrush in a forest, you know, and when the next crisis comes, that debt is just going to explode. And it's going to be so much harder to control than a normal cyclical downturn, you know, the normal garden variety of recession that we've had since the beginning of capitalism and are now trying to prevent. Those things look very benign in retrospect compared to the 2008-2009 Great Recession, or the Great Depression of the 1930s, or the thing that's coming, which is going to be much worse than either of those two things. So it's our own fault, and it's the fault of maybe well-intentioned public policy, but still really misguided public policy. And so at the bottom, when this thing blows up, then we have an interesting argument about why it happened and how we fix it going forward. You know, how we make sure it never happens again, and we set up a system that can grow organically for our lifetimes, you know, at a slow, steady, but nonetheless sustainable pace. And so the argument is going to be between people who say, oh, this is a failure of capitalism, we let these companies get too big, blah, blah, blah. And people on the other side who say, you know what, it was government that got too big, and then companies only got too big because government found it advantageous to allow these big, giant banks and other corporations to expand to this point. And so we need to go back to freer markets and limited government, and perhaps with antitrust laws in place, like after the Great Depression, that keep, especially the big banks, from becoming these monstrosities that we have today. So strict bank regulation, antitrust laws otherwise, and limited government and sound money are the system that the libertarians of the world will be arguing for, and it's going to be a really tough argument, because that's not going to resonate with people who see this as a crisis of capitalism. So I'm not really that optimistic about what kind of a system we end up with, but I am looking forward to the argument. I think it's going to be really interesting, whereas politics now are not interesting, except the Brexit thing was kind of fun. But, you know, standard business as usual financial and political debates in the U.S., they're not interesting. But someday they will be again, and I'm looking forward to that.
Something that we haven't had to face as humans before is the advance of robots. In China, all the Adidas workers, about 1 million of them, laid off so that Adidas can make their running shoes with robots. In Germany, the EU even suggesting that perhaps they put a tax on robots, I think, to help support the people laid off by them.
Yeah, technology is a whole new part of this problem. You know, we would have a gigantic crisis in the absence of automation, just because of the financial mess we've created. But, you know, you throw that in. Throw in the fact that artificial intelligence is now ready to start replacing people all the way up the economic ladder, and run entire factories with hardly any humans, you know, and manage restaurants and stuff, you know. It's going to be an amazing transition, and one that's fascinating from a technological standpoint, but really scary for people on the lower rungs of the ladder. Yes, you can have factories and retail stores and restaurants mostly automated now. So where are the lower rungs on the economic ladder that allow you to get some experience and move up? It's not clear where they are. Meanwhile, we're automating stuff like law firms and money management, stuff that used to be the province of really highly paid symbol manipulators now. AIs can do a lot of that work, and it's only going to accelerate from here because we're at the really steeply sloping part of the parabolic growth chart of the abilities of AIs, for instance. You know, self-driving cars, amazing idea. Seemed crazy a decade ago. And now you've got them on the road. And they're not going to be mistake-free, obviously. We found out just lately because there was a fatal wreck with one of them. But they're going to spread, and they're going to take jobs from, for instance, cab drivers and truck drivers. So there's another entry-level job that's just not going to be there in the future. So yeah, this is really interesting and bleak from almost any angle. You know, it's fascinating and interesting for somebody who has the money to buy, you know, a virtual reality set and play with that new and revolutionary kind of media. But it's going to be a disaster for people who are just hanging on right now, working a minimum wage job, to see that job and all the other similar jobs go away.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. That wraps up our show for this week. I'd like to thank our guests, Ross Clark and John Rubino, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.